Question 1. What is the primary advantage of using a captive insurance company for risk management? A. It allows for access to the state insurance pool for coverage. B. It enables direct insurance coverage without relying on third-party insurers. C. It guarantees immediate profitability for the business owner. D. It reduces the administrative burden of managing corporate insurance policies. Answer: B. It enables direct insurance coverage without relying on third-party insurers. Explanation: the primary advantage of captive insurance is that it enables a company to insure its own risks without relying on external, third-party insurance carriers. This direct insurance arrangement allows businesses to tailor coverage to their specific needs and have more control over their risk management strategy. By forming a captive, a company can manage its own insurance needs, retain underwriting profits, and have more control over premiums and claims handling, which could be a significant advantage compared to traditional insurance policies offered by commercial insurers. The other options are incorrect because they either refer to unrelated concepts, such as state insurance pools, or fail to capture the fundamental advantage of captives, which is risk management autonomy. Question 2. Mr. Adams is the CFO of a mid-sized manufacturing company. His company is considering the formation of a captive insurance company to handle its workers' compensation and property insurance needs. Which of the following is the most important first step in the formation of a captive insurance company in Utah? A. Submitting the business plan to the Utah Insurance Department. B. Purchasing the required insurance coverage for the captive. C. Completing a feasibility study to assess the financial viability. D. Hiring an external claims administrator for the captive. Answer: C. Completing a feasibility study to assess the financial viability. Explanation: when forming a captive insurance company, the most crucial first step is to conduct a feasibility study. This study assesses the financial viability of forming the captive by evaluating the company's risk profile, the potential savings on premiums, capital requirements, and the long-term sustainability of the captive structure. The feasibility study provides a detailed analysis to ensure that the captive will meet regulatory and financial requirements and will be able to fulfill its insurance obligations. While submitting a business plan, option A, and other steps are necessary, they are only done after confirming that the formation of a captive is financially sound. Purchasing insurance, option B, and hiring administrators, option D, are operational steps that come after the captive formation has been validated. Question 3. Which of the following is true about the financial reporting requirements for captive insurance companies in Utah? A. Captive insurers are required to submit annual financial reports to the Utah Insurance Department, but only if their gross premiums exceed $500,000. B. Captive insurers must provide detailed actuarial reports and risk management documentation on an annual basis regardless of premium size. C. Captive insurers are only required to submit financial reports if they are publicly traded companies. D. Captive insurance companies are not required to submit financial reports as long as they are meeting solvency requirements. Answer: B. Captive insurers must provide detailed actuarial reports and risk management documentation on an annual basis regardless of premium size. Explanation: Utah's regulations for captive insurers require all captive insurance companies to submit comprehensive financial reports to the Utah Insurance Department on an annual basis, regardless of their premium volume. These reports include detailed actuarial assessments and risk management documentation, which help ensure the captive's financial stability and compliance with solvency standards. This requirement is part of the broader regulatory framework to ensure that captives are adequately funded to cover their claims and that they operate in a manner that protects policyholders and meets state standards. The other options are incorrect because they either misstate the conditions under which reports are required, option A and C, or fail to recognize that all captives, not just those meeting solvency requirements, must comply with reporting regulations, option D. Question 4. Which of the following is a key benefit of forming a group captive insurance company? A. It allows members to pool their risks and share insurance coverage for lower premiums. B. It guarantees higher coverage limits than individual commercial insurance policies. C. It eliminates the need for regulatory compliance under state laws. D. It automatically provides access to a global reinsurance network. Answer A. It allows members to pool their risks and share insurance coverage for low premiums. Explanation: a group captive allows multiple entities to pool their risks together, which can lead to lower premiums and shared coverage. By grouping together, members can benefit from economies of scale and reduce individual insurance costs. It also provides the potential for improved risk management strategies and access to more customized coverage. The other options are incorrect because group captives do not automatically eliminate the need for regulatory compliance. Option C, do not guarantee higher coverage limits than traditional policies. Option B, and do not automatically provide access to a global reinsurance network. Option D. Question 5. Under UTA captive insurance regulations, what is the minimum capital and surplus requirement for a single parent captive insurance company? A. $250,000. B. $500,000. C. $1 million. D. There is no minimum requirement. Answer. B. $500,000. Explanation. In Utah, a single-parent captive insurance company is required to maintain a minimum capital and surplus of $500,000 to operate legally. This ensures that the company has sufficient financial resources to cover potential claims and meet regulatory solvency requirements. The other options are incorrect as they either underestimate or overestimate the required capital threshold. Captives must adhere to these minimum capital requirements as a measure to maintain financial stability and protect policyholders. Question 6. Mr. Smith is the CEO of a company that is forming a captive to cover its liability insurance. The company is considering utilizing reinsurance to protect its captive from large losses. Which of the following best describes the role of reinsurance in a captive insurance company? A. Reinsurance allows the captive to transfer risk to an external insurer, reducing the captive's exposure to large losses. B. Reinsurance is used to increase the capital and surplus requirements for the captive. C. Reinsurance is required in every captive insurance arrangement regardless of the size of the risks involved. D. Reinsurance is only necessary if the captive does not meet regulatory solvency requirements. Answer. 8. Reinsurance allows the captive to transfer risk to an external insurer, reducing the captive's exposure to large losses. Explanation. Reinsurance is an important tool for captive insurance companies, allowing them to transfer some of their risk to an external insurer. This helps protect the captive from large losses that could exceed its capacity to pay claims. Reinsurance is often used in situations where the captive is exposed to high levels of risk, such as in the case of catastrophic events. It is not mandatory in all captive arrangements. Option C, nor does it affect capital and surplus requirements directly. Option B, nor is it solely tied to solvency issues. Option D. Question 7. Which of the following is a key factor to consider when determining the feasibility of forming a captive insurance company? A. The company's size relative to other commercial insurance providers. B. The potential for self-insurance to reduce long-term insurance premiums. C. The complexity of the company's insurance needs and existing risk management strategies. D. The ability to immediately purchase reinsurance from a third-party insurer. Answer. C. The complexity of the company's insurance needs and existing risk management strategies. Explanation. One of the key factors in determining the feasibility of forming a captive insurance company is the complexity of the company's insurance needs and its current risk management strategies. A company with complex or unique risks may benefit from a captive as it can tailor insurance coverage to its specific requirements. The other options are incorrect because the size of the company, Option A, is less important than its specific risk profile, and while reinsurance, Option D, is an important tool, it is not the deciding factor in forming a captive. Additionally, self-insurance, Option B, may be part of the strategy but does not solely determine the feasibility of forming a captive. Question 8. Which of the following is true regarding the financial management of captive insurance companies? A. Captives are generally prohibited from investing their funds in anything other than government bonds. B. Captives are allowed to invest their funds in a wide range of financial instruments as long as they adhere to investment guidelines set by regulators. C. Captives must maintain all their assets in cash or cash equivalents to meet solvency requirements. D. Captives must invest all their funds through a third-party investment manager without the ability to make decisions internally. Answer. B. Captives are allowed to invest their funds in a wide range of financial instruments as long as they adhere to investment guidelines set by regulators. Explanation. Captive insurance companies are allowed to invest their funds in a wide range of financial instruments, including stocks, bonds, real estate, and other assets. However, they must adhere to strict investment guidelines set by regulators to ensure that the investments are prudent and align with the captive's risk management and solvency requirements. The other options are incorrect because captives are not limited to government bonds. Option A, they do not need to maintain all assets in cash or equivalents. Option C, and they can make internal investment decisions. Option D, although some captives may choose to hire external managers for specific investment strategies. Question 9. Which of the following is not a requirement for captives under Utah's regulatory framework? A. Captives must submit annual financial statements, including actuarial reports. B. Captives must maintain a minimum amount of capital and surplus. C. Captives must participate in the state's insurance guarantee fund. D. Captives must undergo an annual audit by an independent auditor. Answer: C. Captives must participate in the state's insurance guarantee fund. Explanation: captive insurance companies are generally exempt from participating in the state's insurance guarantee fund. This is because captives are self-insured and typically do not need to rely on the state's fund to cover claims. The other options are requirements under Utah's regulatory framework. Captives must submit annual financial statements, including actuarial reports. Option A, maintain a minimum amount of capital and surplus. Option B, and undergo an annual audit by an independent auditor. Option D, to ensure compliance and financial stability. Question 10. Which of the following best describes the role of the Utah Insurance Department (UID) in overseeing captive insurance companies? A. The UID only reviews the formation of captives but does not monitor their ongoing operations. B. The UID enforces compliance with solvency requirements, reviews financial reports, and conducts regulatory inspections. C. The UID provides funding for captives to ensure they meet capital requirements. D. The UID offers tax incentives to captives operating in Utah. Answer: B. The UID enforces compliance with solvency requirements, reviews financial reports, and conducts regulatory inspections. Explanation: the Utah Insurance Department plays a critical role in overseeing the operations of captive insurance companies. Its responsibilities include ensuring captives comply with solvency requirements, reviewing financial reports, and conducting periodic regulatory inspections to ensure that captives remain financially sound and operate in compliance with Utah law. The other options are incorrect because the UID does not provide funding for captives. Option C, or offer tax incentives. Option D, and its role goes beyond just reviewing formation. Option A, to include ongoing oversight and compliance. Question 11. Which of the following is a key advantage of forming a captive insurance company? A. A captive insurance company can offer lower insurance premiums by pooling the risks of multiple unrelated businesses. B. A captive insurance company allows a business to retain its own underwriting profits and invest them for its benefit. C. A captive insurance company can avoid all regulatory oversight from state insurance departments. D. A captive insurance company automatically provides access to international reinsurance markets without additional contracts. Answer: B. A captive insurance company allows a business to retain its own underwriting profits and invest them for its benefit. Explanation: one of the main advantages of forming a captive insurance company is the ability for the parent business to retain the underwriting profits, which can be invested for the benefit of the company. This allows the business to have greater control over its insurance costs and improve its financial stability. Captives do not pool risks from unrelated businesses. Option A, they still face regulatory oversight. Option C, an international reinsurance access requires separate arrangements. Option D. Question 12. In Utah, which type of captive insurance company can be formed by a business to cover its own risks without the need for external insurance participants? A. Association captive. B. Group captive. C. Single parent captive. D. Reinsurance captive. Answer: C. Single parent captive. Explanation: a single parent captive insurance company is formed by a business or a group of related businesses to cover their own risks. It operates solely for the benefit of its parent company and does not involve external insurance participants. The other types of captives, association, group, reinsurance, may involve multiple entities or be structured for different purposes. Question 13. Which of the following is not a typical use for a captive insurance company? A. Covering high-frequency, low-cost risks such as employee health insurance. B. Insuring against catastrophic risks that would be too costly to cover with traditional commercial insurance. C. Offering reinsurance to third-party insurers in exchange for premiums. D. Providing coverage for risks that are difficult to insure through the conventional insurance market. Answer A. Covering high-frequency, low-cost risks such as employee health insurance. Explanation: captive insurance companies are typically used to cover high-cost, low-frequency risks. G. Catastrophic losses and risks that are hard to insure through traditional commercial insurers. High-frequency, low-cost risks like employee health insurance are typically better covered through traditional group health insurance policies. The other options, B, C, and D, are all valid uses for captives. Question 14. Which of the following is a primary consideration when determining the appropriate domicile for a captive insurance company? A. The availability of cheap office space and real estate for the business. B. The regulatory environment and capital requirements imposed by the jurisdiction. C. The number of captive insurance companies currently operating in the jurisdiction. D. The quality of the local workforce and availability of talent. Answer: B. The regulatory environment and capital requirements imposed by the jurisdiction. Explanation: when selecting a domicile for a captive insurance company, businesses primarily consider the regulatory environment and the capital and surplus requirements of the jurisdiction. These factors determine how easily and cost-effectively a captive can operate, while the other factors, office space, workforce, number of companies, may play a role. Regulatory and financial considerations are the most important. Question 15. A company is considering forming a captive insurance company to cover its general liability risk. Which of the following is a necessary step before the captive can begin operations? A. The company must hire a third-party insurance broker to administer the captive. B. The company must submit a business plan and obtain approval from the regulatory authorities in the domicile. C. The company must purchase reinsurance from a commercial insurer to cover all potential risks. D. The company must demonstrate that it has been in business for at least 5 years before forming a captive. Answer: B. The company must submit a business plan and obtain approval from the regulatory authorities in the domicile. Explanation: before a captive can begin operations, the company must submit a business plan to the regulatory authorities in the chosen domicile and obtain their approval. This ensures that the captive meets all regulatory requirements and is financially sound. Hiring a third-party broker, option A, and purchasing reinsurance, option C, are not mandatory steps for starting a captive. There is no required minimum length of time in business to form a captive, option D. Question 16. Which of the following types of risks would a captive insurance company most likely be used to cover? A. Routine property damage claims. B. Workers' compensation claims for employees. C. Risks that are difficult to insure through the commercial insurance market, such as terrorism or product recalls. D. General business liability for claims related to third-party accidents. Answer: C. Risks that are difficult to insure through the commercial insurance market, such as terrorism or product recalls. Explanation: captive insurance companies are often formed to cover risks that are either too expensive or difficult to insure through traditional commercial insurance providers. Examples of such risks include terrorism, product recalls, and other specialized exposures. Routine property damage, option A, workers' compensation, option B, and general liability, option D, are more commonly covered through traditional insurance providers rather than captives. Question 17. What is the minimum number of members required to form a group captive insurance company in Utah? A1, B2, C3, D5. Answer: B2. Explanation: a group captive insurance company in Utah must have at least 2 members to form. Group captives allow multiple entities to pool their resources to cover common risks, and having at least 2 members is necessary for the structure to function. The other options, 1, 3, 5, are incorrect because 2 is the minimum number. Question 18. Which of the following is a potential downside of forming a captive insurance company? A. Increased exposure to high-frequency, low-cost risks. B. The inability to access reinsurance markets. C. The responsibility for managing claims and underwriting. D. Guaranteed tax benefits. Answer: C. The responsibility for managing claims and underwriting. Explanation: one of the potential downsides of forming a captive insurance company is that the parent company assumes the responsibility for managing claims and underwriting. This requires expertise in insurance operations and can be resource-intensive. The other options are incorrect because captives can access reinsurance markets, option B, and while there may be tax benefits in some jurisdictions, they are not guaranteed, option D. Captives are typically used to manage high-cost, low-frequency risks, not high-frequency, low-cost risks, option A. Question 19. What is the primary reason a business might choose to form a captive insurance company? A. To reduce overall insurance costs by retaining risks and underwriting profits. B. To increase regulatory oversight and complexity in its risk management operations. C. To outsource all insurance management to third-party providers. D. To avoid paying premiums to traditional insurers entirely. Answer A. To reduce overall insurance costs by retaining risks and underwriting profits. Explanation: the primary reason a business forms a captive insurance company is to reduce overall insurance costs by retaining risks and underwriting profits. This allows the business to have more control over its insurance program and potentially reduce costs in the long run. Captives do not eliminate the need for insurance altogether, option D, and they do not automatically increase regulatory oversight, option B, or outsource management, option C. Question 20. Which of the following is NOT a requirement for captives under Utah's regulatory framework? A. Captives must submit annual financial statements to the Utah Insurance Department. B. Captives must maintain a minimum capital and surplus of $250,000. C. Captives must have an independent audit performed annually. D. Captives must maintain adequate reserves to cover their liabilities. Answer: B. Captives must maintain a minimum capital and surplus of $250,000. Explanation: under Utah's regulatory framework, the minimum capital and surplus requirement for a single-parent captive is $500,000, not $250,000. The other options are correct. Captives must submit annual financial statements, option A, undergo an independent audit annually, option C, and maintain adequate reserves, option D. Question 21. Which of the following best describes the primary purpose of a captive insurance company? A. To provide insurance coverage for employees and individuals that are outside the parent organization. B. To cover risks that are not traditionally available through the commercial insurance market. C. To offer insurance products to other insurance companies at a discount. D. To help reduce taxes by transferring risks to a separate entity. Answer: B. To cover risks that are not traditionally available through the commercial insurance market. Explanation: the main purpose of a captive insurance company is to provide coverage for risks that are not easily available through the traditional commercial insurance market, such as certain types of liability or specialized risks. Offering insurance products to other insurance companies or reducing taxes are not primary purposes of captives. Question 22. Under Utah law, what is the maximum number of members allowed in a group captive insurance company? A. 5, B. 10, C. 20, D. Unlimited. Answer: C. 20. Explanation: Utah regulations allow a group captive insurance company to have up to 20 members. This limit is in place to ensure that the group is manageable and can effectively share risks while operating under the captive model. Question 23. Which of the following would NOT be considered a potential benefit of forming a captive insurance company? A. Increased control over insurance pricing. B. More predictable insurance costs. C. Access to the traditional insurance market for broad coverage. D. Retained underwriting profits. Answer: C. Access to the traditional insurance market for broad coverage. Explanation: a captive insurance company is designed to cover risks that are not easily insured through the traditional insurance market, so it does not provide broad coverage options like those found in traditional insurance policies. The other options, increased control, predictable costs, retained profits, are indeed benefits of forming a captive. Question 24. What is a common reason businesses might consider using a captive insurance company for workers' compensation insurance? A. To reduce the need for an external insurance provider. B. To avoid paying premiums altogether. C. To cover small claims with lower costs. D. To increase the total cost of insurance. Answer A. To reduce the need for an external insurance provider. Explanation: captive insurance companies are commonly used for workers' compensation insurance because they allow businesses to retain risks and insurance costs in-house rather than purchasing this type of coverage from an external insurer. This can provide cost savings and greater control over the claims process. Question 25. Which type of captive insurance company would be best suited for a group of companies in a similar industry that want to pool their risks together? A. Single-parent captive. B. Association captive. C. Risk retention group. D. Reinsurance captive. Answer: B. Association captive. Explanation: an association captive is designed for groups of companies within a similar industry who wish to pool their risks. This type of captive allows members to share risks more efficiently while still enjoying the benefits of captive insurance. Question 26. How often must a captive insurance company in UT submit its financial statements to the UT Insurance Department? A. Monthly, B. Quarterly, C. Semi-annually, D. Annually. Answer: D. Annually. Explanation: UT regulations require captive insurance companies to submit their financial statements to the UT Insurance Department annually. This is done to ensure that the captives remain solvent and comply with regulatory standards. Question 27. Which of the following risks are not typically covered by a captive insurance company? A. Risks related to product recalls. B. General business liability claims. C. Small property damage claims. D. Cybersecurity risks. Answer: C. Small property damage claims. Explanation: captive insurance companies are best suited to cover higher cost, lower frequency risks, such as large property damage losses, product recalls, or cyber risks. Small, routine property damage claims are more effectively covered through traditional commercial insurance policies. Question 28. What is one potential challenge when a company decides to form a captive insurance company? A. Difficulty in getting regulatory approval. B. The need to hire an insurance broker. C. Higher premiums than traditional insurance. D. Automatic access to international markets. Answer: A. Difficulty in getting regulatory approval. Explanation: one of the main challenges when forming a captive insurance company is obtaining approval from the regulatory authorities in the domicile state, such as Utah. This process involves ensuring that the captive meets all legal and financial requirements. Question 29. What must a single-parent captive insurance company in Utah maintain to cover its liabilities? A. A minimum surplus of $500,000. B. A minimum surplus of $250,000. C. A minimum surplus of $1 million. D. There is no minimum requirement. Answer: A. A minimum surplus of $500,000. Explanation: under UT regulations, a single-parent captive insurance company must maintain a minimum surplus of $500,000 to cover its liabilities. This financial cushion is required to ensure the company's stability and ability to meet obligations. Question 30. Which of the following scenarios is most suitable for using a captive insurance company? A. Purchasing low-cost life insurance for employees. B. Covering medical expenses of employees. C. Insuring large, complex risks such as cyber attacks or product recalls. D. Insuring routine property damage claims. Answer: C. Insuring large, complex risks such as cyber attacks or product recalls. Explanation: captive insurance companies are best suited for covering large, complex risks that may be difficult or expensive to insure through traditional commercial markets. For routine or low-cost insurance like employee medical expenses or property damage claims, traditional insurance solutions are often more appropriate.